Hello and welcome to the You're an Asset podcast. I'm your host, Casey the Dollar. And on this podcast, we find out who is an asset in the financial industry and who is just an ass. Thanks so much for joining me. We are back for season 3, and today I have a very special guest joining us on the show. I just want to brag a little bit because this man has been in the insurance industry for a while, but he's a former Northwestern Mutual agent. And if you don't know what company that is, that's a whole life company. A very large, a very big, well-known whole life company. And he has come to the dark side of Index Universal Life Insurance. And we are so happy to have him. I'm so honored. He now works with us at Power 3 Financial. And without further ado, please welcome Mr. John Walls. Hey, John.
Hey, how you doing? Thank you for having me. I am here on the dark side.
The dark side. Well, some people who are whole life people or whole lifers, as you'd call them, they might call this the dark side.
Yep, they sure do.
Tell us why are you now with Power 3 Financial? What encouraged you to make the switch? Why would you do that? Why would you come over here?
Well, that's a great question. I mean, there's a litany of answers, to be honest with you, for that. Northwestern Mutual, on the face of it, is a great company. However, I think from the standpoint of ultimately the satisfaction I think that I got from helping clients, I felt like there was something that was still missing. I didn't feel like whole life was a one size fits all solution. I knew that there was something better out there. And to be honest with you, you're right. Like in the whole life world, we more or less were taught that IUL is, akin to blasphemy. So, it wasn't until I got introduced to you that I really started doing my own research, right? Kind of in that way. And, found out that it's not just the product that's the problem. Sometimes it's just the people selling it. That's the problem, and ultimately I feel like, what you and the rest of the team at Power 3 had to offer was more comprehensive and more adjustable to what our clients are typically looking for. We'll definitely talk about that today, but
Yes.
I felt like IUL was definitely a much more, like I said, flexible product ultimately at the end of the day.
And that's what we're going to talk about today is basically whole life versus Index Universal Life. And just to make it very clear for everyone, we don't just sell Index Universal Life Insurance. We work with whole life policies too.
Yep.
When something is the right fit, it's the right fit. We're not going to push an IUL on someone who doesn't want it. Whole life has its place and IUL has its place. And that's really more so what it comes down to is having access to the right product for each individual person. How long have you been in the industry, John?
So I've been in the insurance world for 7 years now, particularly in the life insurance and financial world now for the last 3 years. So started off with selling life insurance through State Farm. I feel like everyone, for the first time that they venture into the world of life insurance, they're a little scared of it, right? A little scared of having that conversation with people. But the more that I became aware of not just the life insurance aspect of life insurance, to be honest, but some of the other things that can be done, some of the other tools, a way of using it as a tool, the more I became interested in it. And that's ultimately what led me to Northwestern Mutual, was kind of a merging of the two fields, right? Life insurance and something that I had been interested in for a while, which was finance. And, really trying to figure out, okay, how do we pair these two together? And for that, I'm eternally grateful for Northwestern for showing me that. However, again, like I said before, you know what I mean? I don't feel like whole life was a one size fits all. So I felt like it was time for me to venture out and look for, greener grass, I suppose.
Yeah. I mean, and you can only be as good for your clients as the products that you have accessible to
Correct.
you, right?
Yeah, exactly.
So, what licenses do you have currently?
So I do have my life and health license, not only in California, but I believe right now in about 14 different states. I have my securities license, so took my SIE, took my Series 7, Series 63, actively working on my Series 65 right now to become an independent investment advisor. And then I also have my variable license, so can sell variable life insurance, variable annuities, things of that nature
And
as
so, if
well.
anyone has ever been under the impression that Power 3 Financial is just like, all we do is IULs, that is
Not at all.
officially gone. Like, that is not the case whatsoever. Investment advice, healthcare, life. We
Yep,
are really expanding, thanks to getting to bring amazing people like John onto the team, which is awesome. Um,
I appreciate
Now,
that.
of course, we're lucky to have you, and our clients are lucky to have you as well because it just means that they don't have to go and find somebody else that they can trust. Because usually they're coming to Power 3 Financial because they're saying, "Hey, I like what you guys say. I like your values. Like, what else can
Right.
you do?" And until we have a partner who we also trust to do those things, we
Yeah.
were just doing more of the life side. So
Right.
it's amazing to have you. Well, let's get into whole life versus IUL because that's what everyone wants to talk about, right? Like,
Let's do
oh, the whole
it.
life versus IUL, big debate. I
Yeah.
would love if you kick us off here, like in a very simple explanation, like how does whole life work?
Yeah. I mean, whole life is a permanent product, right? So if we think about the two types of life insurance that people are probably most familiar with, we have term life insurance and then we have permanent life insurance. And then under the umbrella of permanent life insurance, we have not only whole life, but we have universal life and all of its variances at that point. So really, whole life being a subsect of permanent life insurance, you are getting life insurance for life. It's never going to expire. The benefit, and this is what you'll hear a lot of people say, is the benefit of it is a particular, not necessarily guaranteed, but a very steady growth rate in the policy. Right, typically somewhere between 3 and 5% on average is what you'll see dividend rates growing by inside of these policies. Now the thing is they're not very flexible, right? So if we say we sign you up for a policy and you say you want to put $500 in a month, well, you have to put $500 in a month in perpetuity unless we take the policy paid up at some point in the future. Which that's not doing yourself any service if you're doing that because then you're effectively, halting the any future potential growth in the policy. You will still get all the dividend growth on the money that you've accumulated up into that point, but you effectively put a halt on the policy at that point. And then you would need to start a brand new policy if you ever wanted to recontinue putting money in. So there is a lack of flexibility there. But for conservative people, for people looking to maybe, in the words or in the way that Northwestern Mutual designs plans, if we're looking for bond replacements inside of a portfolio, it is a very valid tool to utilize for that. However, there are several limitations. Again, the continuing to have to put in the same amount of premium every single month without fail, year over year over year, without really considering potential circumstantial changes that you may see throughout life, whether that's making more money, making less money, and things of that nature. So, yeah, really, whole life is it's a very vanilla tool. Like, to be honest with you, it's good at what it does, but it's very plain Jane, very vanilla. And
Yeah.
really, the only differentiator between whole life products is the carrier that's selling it to you right now,
Yeah.
and how good or how bad that carrier actually is.
And so the two main things that really separate it from an IUL are the
Mhm.
flexibility
Right,
and the volatility, I guess you would say, of the growth. Right. An
correct.
IUL, it's in the name. The universal term means
Right,
flexible throughout life. And then
right.
the indexed portion means that we're going to track the stock market. So the index earned is going to vary throughout the life of the policy. You want to have a very consistent, very stable policy that's probably not going to grow much. It's going to grow, but it's not going to be anything super exciting.
Yeah.
And you're comfortable with a certain amount of money and you have no doubt that you'll be able to pay it. Great. Whole life
Yeah,
is for
it's
you.
also it's also one of those things too where getting into it, you have to understand that this is not a short-term vehicle for yourself. right? This is not something where you're even going to get a return on the premium that you've put into it. You're not going to hit your break even point until at least year 10, right? Most agents who are selling you whole life will not overfund these policies. A very rare few will, but most will not. So, in the world of IUL, we have our target premium. In whole life, there is no target premium. Your premium is your premium. You can overfund whole life, but again, it's very rare. So, the way in which you're having to think about these things is like, okay, I'm preparing myself for 15, 20, 30 years down the line. Whereas a lot of people want to be able to utilize these not only for the long term, but also for the short term, right? We can't really utilize whole life in the short term like we would typically do for an IUL. So yeah, whole life is again, it's really geared and designed to be a long-term vehicle for people.
So then how come you hear people talk about whole life with infinite banking that you can just leverage the money 10 days in and you want to overfund it? Like, where is this
Mhm.
coming from? Because I've heard you say this before that, like,
Yeah,
you're not going to find someone who's going to set up an overfunded whole life policy. But
right.
it feels like that's what everyone is doing, supposedly, who's into the infinite banking concept. So, like, if
Right,
this is like a magical thing that is not usually being approved by an insurance
right.
company,
Why?
like,
Why are they doing it?
why? Yeah.
The concept is especially people under the age of 40, and they're trying to get into, starting their own business, or they're trying to get into buying real estate or whatever. These are very useful tools that the wealthy have been using for an extremely long time to do just that. And people are catching on to that now, and they want to be able to utilize these things. But the problem is if you're using whole life, you have to put so much money into it up front that it becomes very prohibitive for people. So not everyone has, 100,000 or $150,000 to dump in to these policies year one in order to be able to get 50 grand, 60 grand back out for a down payment, or an investment opportunity or anything of that nature. Right. So that's really where, I started to realize that this universal life package or this universal life contract was actually superior for a lot of what our younger audience or our younger clientele was actually looking for.
And I mean, not a lot of people have 100 grand to just put into a policy, and it's not a one-time 100 grand either.
No, it's if you're going to do that, you have to do it every year.
Yeah, every year. So like you want to have the 100 grand, but you also have to have 100 grand to just throw and lock up
Hmm.
a portion of it
Right.
and be willing to pay cost of insurance, not be able to access it immediately, put another 100 grand, and
Yep.
then be okay with making maybe 4%
Yeah.
a year.
Exactly. Again, you have to be very flush with cash, and that's where I started to realize at the end is whole life was really it is still a rich man's tool. Now, again, if you're more conservative, then there's maybe an argument for it. However, and this is what I think, kind of uncovering what possibilities there are with IUL is like there's fixed accounts in these IUL vehicles, right? So if you really wanted to be super conservative, you could just put 100% of your money into the fixed allocation of an IUL policy, and effectively you're getting the same thing.
A fixed universal life policy.
Yeah, and that's exactly, that's kind of when the light bulb clicked on, so to speak, is, oh wow, you're given the opportunity to be flexible with something like this. So if I wanted to just effectively create a whole life policy for myself for a period of time, I could, and then as soon as I'm done with that strategy, I can change it on the fly whenever I want to be more aggressive or more conservative at will. And that's a unique opportunity that you have with these IULs that you literally do not have with anything else, especially on the whole life side.
And even to just have a strategy where you're putting half of the money into a fixed option where you're earning a guaranteed 4.5%, for example, and the other half you're tracking the S&P 500. It almost doesn't make sense to go with a whole life policy when you don't have the ability to earn any more. Like, it really
Correct.
doesn't, unless you are that guy that says, no, I don't even want to take a chance on anything not earning something. And, for whatever reason, you're okay with just a steady 4% per year. Lock it in, out of sight, out of mind.
Yep.
That's just not everyone's perception of how their money should be working anymore these
Right.
days either.
Right.
Investing and having your money constantly work is such a kind of like trendy and on topic thing for people these days because of
Right.
social media putting out all of this information. Like everyone is all
Yep.
about high yield savings accounts, even using that instead of just using the bank because they're
Yep.
realizing you need to have the money doing something. Right.
Yes.
So it's kind of taking whole life just out of the game unless you're that super wealthy guy who just says, yeah, I'm going to put it here, lock it in, don't worry about it, and eliminate any sort of potential risk, as some would say that the IUL has because of its, what, 0% floor.
Yeah, and I think, truthfully, that's it, right? Is if someone's going to come with an argument against IUL versus whole life, that's really the only ground that they're going to have to stand on. And this is again stuff that we would talk to clients all the time about when we're thinking about indexing against the S&P. What we're essentially doing is tracking the movement of that, and on any given year, and you can go back to the 1920s, the S&P, or the stock market in general, has been up 73% of the time, which just means on average, one out of about every 4 years, the stock market is going to be down. And yet, if you look at the historical return of the S&P, it's still north of 8, 9, 10% over that same period of time. Meaning, the down years, while yes, they can have an impact, especially if you're selling during down years, they balance themselves out over time, right? And that's kind of where I feel like the argument in that context falls apart. We're going to at least do our fiduciary responsibility and letting you know what the math looks like, and what the ultimate outcomes may potentially look like.
And another point that hasn't come up at all either, like even after all of this, like is the loan rates.
Hmm.
You want to borrow from a whole life policy, and do this infinite banking concept after you do have the money.
Yeah.
The loan rates with Northwestern Mutual were what?
I believe they were right around 8% if you were going to borrow from Northwestern Mutual. And when I left, their gross dividend rate was 5.15%. That's before fees. So net was probably going to be somewhere right around 4.5, 4.6, something like that. But even then, there is no such thing as positive interest rate arbitrage inside of a whole life policy. This big selling point is it's going to be lower than what you would get through a traditional loan or through a bank or something of that nature.
Yeah.
But you're never going to make money borrowing your own money in a whole
It's
life policy.
it feels very obvious that that is what whole life people are selling, and to some degree like they think
Yep.
that there is money to be made off of borrowing from your whole life policy. And
Mm.
they don't say flat out like you're earning a positive arbitrage. They're just like, no, like you're making extra money by doing this, or you're saving money by doing this, like you said. But that's because they're using it, to compare it against a loan from a bank or a HELOC, whatever. There's still lower
Yeah.
rates out there when we look at other life products.
It's funny because I feel like you have a key insight into the old Northwestern sales process, because that's exactly it, right? And it's like when you're comparing a 1, 2, maybe 3% interest rate versus 6 or 7, sure, it's going to look great, but that's also leaving out the fact of what else is possible, right?
Yeah.
And you're never going to find a Northwestern Mutual person talking about how their whole life policy compares to an IUL policy unless it's brought forth by a client. And even then, they're going to talk about fees and they're going to talk about this, and without really knowing how these policies are structured, or anything of that nature. But yeah, I think it's just one of those things. When you leave off the table the best option, you can show yourself in a favorable light. And I think that that's the key aspect of the sale of whole life, is just comparing it against worse options and showing it that, like, it's marginally better than all of your other options, but only marginally, right? And for some people that's not good enough.
It's not good enough. One,
No.
I've had a whole life guy on the show before, and he straight up said, when I show clients whole life policies and their illustrations, I never show retirement income.
No. Mm-mm.
Like, and that's the same for Northwestern too, right? You don't show
Yeah.
retirement income. You don't even talk about that. That's not even a selling point.
The big selling point of whole life, and I feel like to this day, if I was still going to recommend it in one context, it would be against bonds inside of a portfolio. And that is what Northwestern Mutual advisors live and die on, is comparing using that EY study. If you're not familiar with it, Ernst and Young put out a study a few years back, talking about utilizing not only whole life products but deferred income annuities as well,
Mhm.
inside of a retirement plan, right? As opposed to just using term and investing the difference. You'll hear Dave Ramsey, people like that talking about that kind of strategy. But really, the Northwestern strategy is essentially just taking whatever your bond allocation would be inside of your portfolio and replacing that with whole life. Now, on the surface level, although complicated to most clients, it makes sense. But ultimately, at the end of the day, people aren't just looking for a marginally better option than bonds, right? Because people are familiar with bonds. They've heard of the term before. They're comfortable with it because it's just automatically added to their 401k. So when you come in and say, "Hey, take all of your investments, throw it all into the S&P," because that's typically what they're going to tell you to do. Throw it all into the S&P or to this pre-built fund that is only going to track maybe a 10 basis points better than the S&P, and we're going to charge you 1.65%, by the way, to manage those funds. And then throw the rest of your money into this whole life product that you have no idea what this is about, right? This is your first time hearing it about it in this context. You maybe have heard of whole life maybe once or twice before, but have never really looked into it. At the end of the day, most clients are just going to be like, well, I think I'll just probably stick with what I know works, and
Yeah.
we'll see what happens at the end of the day, because my 401k went up by 12% last year. So must not be doing that bad, right? So I
Uh-huh.
think for a lot of people, introducing whole life in that context, although it could potentially be a help, it ends up being more complicated than necessary. When in reality, it's just like, from your retirement standpoint, do what you're continuing to do, and let's find a way to supplement that retirement, right? And then that's where I
Mhm.
felt like IUL really came in, is supplementing that tax-free retirement that everyone harps on so much, is trying to lower your taxable income during retirement. Yes, and while you theoretically can do that with whole life insurance, no one's ever going to show that to you. Especially from the Northwestern side, it's very complicated to show that in their planning system. And most people are building these plans maybe a day or two before they're having their meetings with you. So likelihood is they don't have time to put that in there. So when they say that they don't show it, it's probably because they're too lazy to put it into the
Well,
illustration.
and wouldn't you expect there to be a negative, obviously a negative arbitrage that is just going to drain
Yes.
the overall value of the policy so quickly that, like, what's
Yeah.
the point? Like, you're basically showing, hey, like, look, it's so great, and you get to retirement and
Mhm.
you can pull out income for like 10 years and then you have nothing.
Yeah, and that's it, right? So essentially, there's a chart that is pre-built into the financial planning software of Northwestern Mutual that will effectively show you. It's based upon a cash reserve that will essentially say, hey, you retire with $1 million. And if you were only ever to withdraw your money from your 401k, it would last you, I think in their examples, like 20, 25 years.
Yeah.
Now, with our cash reserve, effectively, what you could come in and do is supplement those down market years with money from your whole life policy, and effectively help to make your 401k last longer. So, really, when we're talking about it in the context of whole life, we're not talking about adding yearly additional retirement income. We are talking about it there as a supplement to help make your traditional retirement accounts last longer. And even then, it's not guaranteed to do that, right? Lifestyles change. With inflation, the cost of living continues to go up year over year. We don't know what taxes are going to look like by the time, people my and your age are going to retire. If Social Security is still going to be around to help supplement some of that income, we don't know all of these things. So in reality, to be able to look someone square in the face and say, hey, keep doing what you're doing in your 401k, add this here, and you're going to be crystal clear, you're going to be fine. I just couldn't sleep with that. Right. And being able to show people, just yesterday was showing, someone 30 years old, she wanted to put $500 a month into, or $550 a month into a policy, showed her starting at age 65, being able to pull out $57,000 a year from 65 until she was 120 years old. Right. It's extremely powerful in comparison to having to play this rodeo where we're talking about bond replacements and cash reserve distributions and all these types of things that, by the time you get to it, most people are bored, their eyes have rolled into the back of their head, and they can't wait to get off the Zoom call with you.
Well, and with an IUL, like, I mean, 30-year-old being able to save up enough money and grow the money ultimately in the cash value of an
Hmm.
IUL to the point that they could take a fifty to $60,000
Right.
income that is based on a positive arbitrage. But
Yes.
I just want to clarify for the listeners, right, that when we are doing these illustrations, the loan rate is 5%. And I guarantee that John was showing a 6.3% return.
Correct.
So we are
Mhm.
talking about an arbitrage each year of 1.3%. That's it. And if there was ever a year where the market crashed and we could plan ahead, right? Because obviously, like, market crashes out of nowhere, but you can
Mhm.
switch your loan options in the middle of the year with an IUL, and you
Yep.
could take in that same policy a 2% standard fixed rate and have your loan amount credited back 2%. The market is losing, the IUL is not going to perform, the S&P is going negative 20. You're going to pull out a loan 2%, get credited back 2% guaranteed,
Yep.
and that is how you would then even save your own policy from being affected by a negative arbitrage. Like,
Yeah.
there's also fail safes within the IUL to make the income later on even less risky.
Well, and I think about it this way too, and it's something that we were talking about this morning is those index locks. If we're doing our job, then we're monitoring the market for the clients.
Mm-hmm.
And again, even though it's not an investment tool, it's tracking these investments. So it is still incumbent upon us to make sure that, if the market has been tracking well for the last 3-4 years, then inevitably within the next year or two, we're probably going to see a dip in the market, right? And that will likely happen intra-year. So meaning it's not going to start, the market's not going to be down 27% and stay there starting January 1 of that particular year. It may be up 30% until May and then tracks downward to where it finishes negative 20% by the end of the year. So we have
Mm-hmm.
the ability, even on a year where the market is down, to lock in a positive crediting rate in that particular policy. At that point, it's not necessarily foolproof because there definitely may be times where you miss the peak on something like that. But
Yeah.
for the ability to have these auto locks set in place, it's a no brainer, right? Where you could watch everyone else, losing their behind in the market, while at the same time you're locked in at 7.5, 8%.
And that's something we've never even touched on online, on socials, or on the podcast yet. Is we're always just saying, the worst you can do is 0%. Everyone else is going to lose 20, 30% in the market, and you're
Wrong.
going to be
Yep.
locked in at 0%. But
Right.
now John is spilling out all of our secrets here.
Whoops.
No, it's good. It's good because there are indexes where, you could be 3 months into your policy. The index
Mhm.
option has gone up to 7%. You're locked in. Doesn't matter what it did next year. That's incredibly valuable
Yep.
to have the capability to say, know what? I'm good at 7. I don't need to know if it's going to drop in the next 6 months or the next 9 months. Lock it in. 7 feels good. This is a life insurance policy. We are not
Yep.
after 15, 20% returns on average. We're after a steady, call it 8% on average return
Right.
that is going to build up tax free capital that can be borrowed to supplement income or to be a main income stream for someone. I know that a lot of our clients would even be happy at just 6. If I just got an average 6, because that's what we always
Mhm.
show, like, they're
Yep.
stoked about it. And to the point when we're talking about interest, when we talk about how the whole life policy earns, what do we say, 3 to 5%? That 3 to 5% is not guaranteed. It's non-guaranteed based on the
Correct.
dividends that are potentially given out to each policyholder.
And also that's whatever the illustrated dividend rate is on a particular policy, whether it's through Northwestern or Mass Mutual, New York Life, doesn't really matter. Everyone needs to know that those are gross dividends, not net dividends, right? So those are gross before fees. So likelihood is like I said, you'll probably end up between 2.5 and 4.5% net at most, inside of one of these. And yes, they are all non-guaranteed. So for a lot of the larger companies, it is all but guaranteed, right? But for especially for if you're buying whole life policies from some of these smaller whole life companies, they could rescind that dividend at any time for any reason with minimal notification to you. And there's really not much that you can do about it, because what they'll show you on these whole life illustrations, essentially what you'll see is there's two columns. There's your guaranteed and your non-guaranteed values, similar to what you'll see with an IUL.
Yeah.
But you'll notice that the guaranteed value is always 0%. With basically, you're just crediting, you're just getting interest basically on the money that's sitting there of about less than 1% year over year. There's minimal growth in order to keep the policy viable, but you're essentially growing the policy by your premiums that you're putting into it, plus a very, very marginal amount at any time. And this could also include Northwestern Mutual. Don't be fooled. If there is any sort of catastrophic event or anything like that, you could very well see these companies, rescinding these back to the guaranteed rates without question.
I was just going over a lot of the total interest earned on a lot of my IUL policies for my clients. And so when we're talking about 2 to 5%, and that it's not all 100% guaranteed,
Right.
we're talking about IULs earning 11% for the year.
Mhm.
12% for the year,
Right.
9.5% for the year. I personally earned 12.7% in my IUL, and I set it up the same way that I set up all my clients. I just had a client earn $18,000 in his IUL for the year. That's not something that you're going to see on a whole life policy. Now, yes, next year, maybe he only earns $1,000.
Sure.
Okay. But at the same
Yeah.
time, it's not, because I put 30% of his money into the fixed account. So he's
Yeah.
going to earn, he's going to earn interest no matter what.
Well, the way that I would look at it is this: whole life would be more akin to something like a CD or a money market account,
Yeah.
right? Where you're going to make better than savings account average. Right now, money market accounts are probably paying somewhere between 4 and 5%, right? Which is what you're going to find in a standard whole life policy. Big difference is the money market accounts, they can fluctuate with interest rates, but so can whole life policies. And then putting your money into something like an IUL would be more akin to putting your money into the traditional market, right? People aren't scared to put their money into the traditional market because the market goes down some years, right?
Yeah.
But it is just about understanding that the up years always outweigh the down years regardless, right? And this is not just me saying this is not my opinion. You can go back to 1926 and see that there has never been a down 15-year period in the stock market since its inception. And again, that is not opinion, that is fact. So again, even though it is not an investment vehicle, if we are tracking the market, that is to say that we will never have a down, at least we will never have a down 15-year period in our policy. And more than likely, we will be making over that same period of time substantial percentages above and beyond what we would get in any safer vehicle.
And how you said that whole life policies are not like a short term commitment. IULs are not a short term commitment either.
Correct.
Like they're not. It's a life insurance contract. That's why it's not an investment. It's because it's a contract that lasts your entire life. If you want everything that it's able to offer, you have to keep it, and you got to make a commitment to it no matter what. Your commitment might be 5 years of funding or 10 years of funding, but you're going to keep it open and keep working with an agent or managing it for 20, 30, 40 years or the rest of your life.
And you'll be thankful that you did.
And you'll be thankful that you did 100%. So John, was it wild to you to see that IULs offer a 2 or a 2.5% guaranteed return as well? Like, was that something that you were like, no way? Like, because I'm sure you heard a lot of bad things about IULs beforehand too, that there's no
Yeah.
guarantees, all of this, and then come to find I'm like, look at this.
Well, I think of all vehicles in this industry, I think the one that gets the worst rap is IUL. And I think mostly that's because of the people, not because of the product. So yeah, I think a lot of the misconceptions, including my own misconception coming into this, was that it was just an inferior product, right? Where it was expensive. The policy would eventually cave in and lapse on itself or eat itself to death, as we would say to a lot of people. So there's a plenty of misconceptions about the actual product itself. And to be honest with you, maybe less than 1% of advisors that primarily sell whole life have any idea an IUL illustration even looks like, right? They maybe have seen one that a client has brought to them, but then they only look at it through the eyes of how can I pick this apart and make this look as bad as humanly possible,
And the
right?
agent who set it up probably set it up to make it easy for the whole life guy to pick it apart. So we
Mhm.
know that it's more common for somebody in the industry to get an illustration of an IUL that is absolute trash than for
Yeah,
them to get a good IUL illustration where it would be hard for them to poke holes in it because it's not very common, sadly.
yeah. And again, like I said before, you can structure these IULs, and this is something again I had no idea until I sat down with you for the first few times and we went through these illustrations. Is that there is a fixed account option in these IULs that if you didn't want it to track the market at all, it doesn't have to. It's their fixed account, right? And it works in the exact same way that a traditional whole life general account would work.
And the highest fixed account we have right now is beating a whole life policy.
It is, yeah.
5.4%.
Yep, which is bananas that they're able to offer you that. And again, in the way that we structure our policies, putting 20% allocation into that, that's, if we're thinking about the money that we're putting in, 20% of your overall funds and then 5% of that, we're talking about, roughly 1% guaranteed return that you're getting on your money year over year, which more than covers the cost of the fees of these policies. So when we're talking about a 0% floor, we're now actually talking about a true 0% floor in your policy, whereas opposed to most people, if they put 100% allocation to the S&P, well, when you have your 0% years, you're probably actually going a little bit negative because of the fees that are being associated with that. So you'll see your cash value dip. Whereas in the way that we structure these policies, this is the genius part about it. I feel like is that we are guaranteeing to a certain extent that people will not lose any money. They'll at least have that true 0% floor.
I've been trying to tell people for years at this point that IULs really can be a way to make sure that you don't lose any money. And
Correct.
even if you didn't earn any money in the IUL and you just broke even on the cost
I
every year, you're still putting your money into a tax sheltered vehicle that's
Yeah.
offering your family tax free generational wealth, right? And protection throughout your lifetime, and you're still able to access that money tax free at a lower loan rate than you're going to find anywhere else.
Yep.
Like, even if it did just break even, if you're putting 12 grand a year, and what is that, after 10 years it's 120 grand, and you have just
Mhm.
about 120 grand and a $300,000 death benefit,
Yep.
and all 120,000 is accessible to you tax free. You can access it at any point, and worst case scenario your family would get $300,000 tax free. There is value in that regardless, and
Yeah.
you're not going to find that in any other vehicle.
This is a tool like life insurance as this type of tool has been used by the wealthy and the rich like this for decades. And when these universal life products came around in the 80s, it just kind of took off from there, right? Because people of wealth have these teams of advisors around them that are able to comb through these policies and find these different ways of utilizing debt and leverage for yourself in a much more favorable way than traditional means, and have been doing this without fail the entire time. And it's only now that people, I suppose, I don't mean this in any sort of derogatory way, but that aren't worth tens of millions of dollars are now finally starting to catch on to this.
Yeah.
And it's the people, not the product. So yes, there are plenty of charlatans out there. There are plenty of people that will write these policies only to line their own pockets, and I would encourage you to be cautious of those people. But at the end of the day, you kind of have to be able to read between the lines and say, okay, despite all of the noise, what is going on? What is actually possible, inside of this instrument, inside of this contract, and how can I best utilize this for my own benefit and my own family's future benefits, and including generational wealth.
Yeah.
So, with the exception of quite a few things, but if the rich are doing it, my interest is piqued.
Yeah. 100%. I mean, obviously, like, rich people, the wealthiest of us, they're not being offered 401ks. for
No,
one,
they're not
they're
putting
not
money in.
eligible for a Roth IRA. They make too much money that a traditional IRA, even, I mean, that's chump change to them. 20,
Yeah,
what, 24, 26 grand a year. They,
it's nothing.
that's nothing. So
Yeah,
what does that leave them? The
yeah,
stock market where they're risking all of their money?
yeah.
They're not doing that with 100% of their money. Real estate, of course, but real
Mhm.
estate locks up your money. So where are their liquid funds? That doesn't
Mhm.
leave very many
But
options.
you also have to understand too that even if they were using those vehicles, 401ks, or the wealthier would use something like a cash balance plan or a profit sharing plan, something of that
Yeah.
nature. But even then, that money is still locked up until your retirement years. So what are you
Yeah.
utilizing between now and then ultimately,
Yeah.
right? And then something to also consider, because this is an argument I hear now on social media and I hear all over the place, is, well, you're still better off putting money into an investment account, because much like you can borrow against your life insurance contract, you can borrow against or leverage your investment vehicles. And that is only true to a certain degree. Keep in mind that effectively whatever you want to borrow, you need double of that amount in the account, because that's the max amount that you can borrow on margin, right? And you would be borrowing on margin, which leaves you susceptible to margin calls, right? And then that would force you to come up with that money within a very short period of time in order to pay that back. So that is not the case with these IULs. So while yes, you can,
90% liquidity
yeah,
from the
well, at
jump.
the same time, yeah, if the stock market takes a dive, it's has almost zero impact on your capability to borrow from yourself.
Yep. And there's not going to be this, you better pay back your loan right now or we're going to
Yeah.
cancel the policy. No, you're making your premium contributions. No one's going to ask you for that loaned amount back, even
Mhm.
if the market crashes.
Yeah. And I think that that's a good point, right? And this is something that I try and convey to clients all the time now is look, no, you are under no obligation to pay back the loans, but I want you to think about it this way, right? If we are utilizing these loans for something during your working years, or during, if we're using financial planning terms, during your accumulation years, you should really do your best to pay yourself back,
Yeah.
right? Because it's only going to be in your best interest later on down the line for you to get the most out of it in your retirement years, when we're going to recommend that you don't pay it back,
Yeah.
right? So it is not a must do, right? But it is one of those things that if you want to get the most out of it at the end of the day, you will.
Yeah.
But again, it's on your own terms. You can pay it back at will, whether it's monthly, yearly. You want to start paying 5 years from now, that's also fine,
Yeah.
which is just a benefit that nothing else can provide you in that same way.
So much information in this hour that we've been here, John. It's amazing.
Been an hour already.
It's been an hour already. Yeah. I think that anyone listening to this is probably just like, holy shit, I need to go back and hear what he said again, because so much valuable information. And just to make sure, what else, if anything, would you add to this conversation? Did we miss anything that you feel like is really important we didn't go over? Or,
I don't know if there's anything that necessarily we didn't go over, but again, I think something to reiterate, and I could never reiterate this enough, is A, do your own research, and B, it's the people, not the product. And if you're getting red flag vibes from your broker or from your agent, then run for the hills, right? Likelihood is that they're just using you to line their own pockets, right? And I was just having a conversation with a brand new prospective client, and she was talking about how a conversation that she had had in the past with a different agent, and the hurriedness with which they were bringing her along this process, and even using terminology of like, oh, usually people sign by this point in the conversation. Look, if we're talking about people's finances, we're talking about people's future and their wealth, it runs on your time, right?
yeah,
You being the client, not our time, right? We are here to serve you at your pace. Yes, we can make recommendations, but at the end of the day, if you're not ready to put $500 or $1,000 or whatever into something today, that's not for us to decide, right? And if you're finding people that are forcing you to do these things or hurrying you to do these things, run, and run as fast as you can, because those people do not have your best interest in mind. I do not care what company they are working for. There's a quota that they are trying to hit, and you are a part of that quota. people in the financial services realm should not be worrying about quotas. They should be worrying about finding the best people that they can help and helping them the best way that they can. And then that does not mean hitting a particular sales number. So all I would encourage people to do is just be cautious of the people, not necessarily the product.
It's the best advice that we could possibly give anybody
Absolutely.
listening to the show is just please do your own research. And if you don't want to do your own research, hi.
Yeah, we'll do it for you.
We'll do it for you. And we won't push you to sign anything. John, one of the cases you just finished, it took about 4 weeks to like get through the whole process because it's just education. More education, more answers, more questions, and waiting until that person says, okay, that's it. I'm ready. I'm done. Okay. And then I'm here for you. That's how it should always be.
Since I've been with Power 3, I have never once asked someone to sign anything. Never once. And they've done it. You work on people's pace and they respect that more than anyone knows. And also another tip for people, and I think this was kind of one of the first things that I did when I came on was look people up, Google them, Google your broker, Google your agent, see if they have any disclosures against them through FINRA, through the Department of Insurance, whether they have pending lawsuits against them or otherwise. You'd be very, very surprised how many people out there have pending disclosures against them.
Everything is available. Google is your friend. Google is your friend. Amazing. John, it was so awesome to have you on the show. This was such a valuable episode. I hope you guys got a lot out of it. If you want to talk to John and you want to work with him, reach out to Power 3 Financial. That's where he'll be from now on. We've stolen him over to the dark side. And, he is now part of the team. You can reach out to us. Request John if you want to talk to him. I'm sure there's going to be people that are like, you know what? He seems like a smart guy. I want to work with him. I could feel it. Especially these whole lifer guys that are now, you're going to sway them to be like, what are you talking about?
Look, as long as we get the wheels spinning, that's all that matters. And look, and even if the conversation is not necessarily about life insurance, you just want to talk about savings, budgeting, retirement, whatever.
Because you remember all those licenses that John has. So
and I'll do that, especially if you come through the channel of Power 3, all of those conversations will be complimentary. We are here trying to better people and not necessarily just take people's money. So
I didn't even have to teach him this, you guys. He just came this way.
Happy to have any and all conversations with anybody about this stuff. It's what I love to do.
Amazing. Well, thanks so much, everyone, for listening. Everything you need to reach out to us is in the description under this video. Send us an email to info@Power3 Financial. Reach out to us on our socials at power3financial.com. Stay tuned for another episode next week. Find us on Spotify, Apple Music, anywhere you get your podcasts, and I'll see you there. Thanks so much for listening. Bye.
Later.
The You're an Asset podcast is not giving financial advice. We are not licensed financial advisors, and our licensing is strictly in insurance products. The information that we talk about is specific to the products that we work with. We cannot guarantee that other agents will have the same product features that we discuss on the show.